Welcome to our monthly market update, the first of 2017. It gives me great pleasure to wish everyone a happy and prosperous new year. Now, before we look ahead, it is worth spending a moment or two reflecting on some of the lessons from last year. The first lesson is that staying invested, investors are open to opportunity. Last year, one of the main counterbalancing effects against equity and bond volatility was through devaluation of the pound. Now, this boosted the value of international equity and bond holdings for multi-asset investors. The second lesson is that as we cannot know the future with certainty, diversification is vitally important. Looking more recently in December, both bond and equities produced very positive returns, with many equity markets reaching new highs despite ongoing concerns about the outlook. We can see the returns in December from our chart. The recovery we see in bond prices represents a partial rebound following the initial sell-off after the election of Donald Trump on his pro-growth programme for the US economy. In fact, December was a particularly good month, capping off what turned out to be a good year for investors prepared to take some risk. As we look forward, investors are now contemplating a new politically driven economic agenda around Europe and Brexit, around the move away from austerity towards spending on infrastructure, and the possibility that faster growth will put upward pressure on inflation and interest rates. In the UK, even if inflation picks up, the Bank of England are looking to ward off uncertainty around Brexit by keeping monetary policy loose. Now, this isn't good news for cash-based savers, because if we do get rising inflation with low interest rates, it decreases the spending power of low-risk investors over time. Without doubt, we will have new issues to confront in 2017, some that we haven't even thought about today. With multi-asset investing, events based on uncertainty drop like pebbles into a multi-asset pool, creating ripple effects, but not a tsunami effect, which swamps investors and can lead to panic decisions at the wrong time. We cannot foresee the future with certainty, but multi-asset investing can moderate uncertainty through diversification. With our advanced diversification strategy using the True Potential portfolios, our aim is to help savers focus on objectives that matter, like lowering the costs of investing where possible, aiming at preserving and growing wealth through investing regularly and with a long-term focus. Now, it isn't solely about managing risk, it's also about aiming at opportunity, through engagement with 8 world-class manager partners who are skilled enough and have different approaches to cover a vast array of opportunities as they unfold. Thank you very much for listening.
Okay, so welcome to our commentary on the True Potential portfolios. So before we start, I'd like to wish you all a happy and prosperous new year for 2017. So what's the format for today? I'm going to discuss the performance of the portfolios, what changes have been made, and also look to see what are the key themes that we're seeing from our fund manager partners. As an aside to this though, I'd like to say that the True Potential portfolios now have over £1.7 billion invested since we launched on October 2015. I'd like to take this opportunity to thank you for your continued support. For me personally, I've worked for both asset managers, I've worked for an investment bank, and I've never seen this level of assets come into a product so quickly. Okay, so let's move on. Let's now look at performance. Starting off with December, you can see the portfolios have posted some good, solid, positive numbers, with post-Trump election optimism helping to drive returns. Looking back to performance since launch, we're very pleased with how the portfolios have performed, with returns varying from 9% for defensive, right the way up to nearly 25% for aggressive. You can see that investors who've been willing to take on more risk have been rewarded. Okay, so as you'll know, we speak to our fund manager partners at least monthly, looking for any short-term key themes, and then we can tilt the portfolios to take advantage of these themes. One theme that we're seeing is that many of our managers are seeing value within Europe, feeling that we could see some solid growth coming from this area. Europe has underperformed other developed markets over 2016, with many investors nervous of political risk. However, sentiment is changing, and some of our managers feel that there could be significant growth from here. The next theme that I'm going to discuss is the US dollar. So this is very much in focus as our manager partners look to understand whether current levels of high strength will continue and exactly how will that affect other asset classes. Emerging markets are one of the main discussion points as managers look to see whether a strong US dollar will cause problems for this area. Okay, so let's take a look back at what's been happening over the months. So what happened during the rebalance in December? So we made changes within two of our portfolios, and they are Balanced and Balanced Plus. Okay, so let's start off with Balanced. And what we've done here is we've reduced the position in the True Potential Allianz Balanced Fund. So it's got the highest risk measure within our Balanced Fund range. And the fund is more momentum driven without any significant exposure towards value. And this is a style that we're currently favouring right now. We correspondingly increased the holding in the True Potential 7IM Balanced Fund to benefit from a series of defensive-based strategies they have implemented in order to mitigate risk at a time when market volatility is low, but vulnerable to risks on the horizon. As well as that, the 7IM fund also has a skew in favour of value. For the Balanced Plus portfolio, the True Potential SCI Cautious Fund has been reduced due to their exposure to minimum volatility equities. So this is an area of the market that has seen huge inflows this year. The strategy has worked well as a bond proxy strategy, but with bond yields rising, the strategy is now facing headwinds. Last month, as you might remember, we introduced the True Potential Schroder Cautious Fund to provide increased fund manager style diversification. As this fund has a low bond exposure with a larger weighting in cash and a value orientation, so a style orientation towards value across equities, we increase the position. Looking at the rest of the True Potential portfolio range, allocations have been kept the same, with the optimization of all four factors continuing to be paramount within the portfolios. Okay, so now let's turn to look at our wealth strategy and strategy fund range. I'm going to start off by looking at Close Brothers. So Close Brothers are cautiously optimistic on equity markets, but however, they are a little bit more cautious, a little bit more nervous on fixed income. And within fixed income, they're keeping an eye on what they feel is a good entry point for yield levels to increase their exposure to this area. Looking at fixed interest overall, they've been reducing exposure over 2016, having around about 31% for their balanced fund in June. They've now reduced that down to 21%. Also, the duration of the funds is around 3 to 4 years, and that's quite short duration, so less sensitive to changes in interest rates. Looking at equities, Close have reduced their exposure to the US and increased their UK exposure, taking the view that there could be higher levels of volatility in the US, and they've invested in the UK as they want to increase the fund's home bias and also to reduce currency risk within the fund. Next, we have UBS. So UBS have posted some strong figures over the month, with their value bias helping to drive return. In the US, UBS feel that there could be a pullback, not necessarily in equities, but potentially more in bonds. Normally, where the US leads, other developed markets follow. However, there is a disconnect currently between the US and Europe. Looking at the US dollar, UBS feel that we're in the late stage of strength, although within their currency fund, the CARS fund, they're overweight currently. Finally, looking at China, they feel it will perform well over the short term, so in the near future, but could struggle later in the year. Okay, so let's move on and look at 7IM. So looking back over 2016, positive 7IM have been the positions in high yield and also private equity. And the sort of more detractive things that detracted from performance were the UK equity positions and also UK corporate debt. So 7IM are positioned for a brightening outlook, but moderate fiscal and monetary stimulation. So they project global growth of anything from 2 to 3% for 2017 and a position towards a stronger US dollar. The key diversifiers within their funds are alternatives, such as their inflation-linked note. In general, the alternatives have performed well, and they've increased their weighting to this area at the expense of bonds, an area that they could feel could sell off, although they are happy holding a small allocation to US Treasuries. Okay, so let's move on to Schroders. So Schroders have posted some good performance figures over the month. Schroders feel that we are seeing a change in how investors view markets. Last 4 to 5 years, investors have been concentrating on lower for longer when it comes to interest rates, which they feel has led to massive imbalances in the market. Looking at the US versus Europe, Schroders see more value in Europe, with corporate profit margins still below their prior peak, but for the US, margins are now at elevated levels. They feel that the US is more late cycle and that incremental growth doesn't come without inflation pressures. There have been no new managers introduced this month, but Schroders are currently looking for more value-style orientated managers to add into their funds. Okay, so next let's move on to Allianz. And actually, if we look back over 2016, Allianz really have posted some stellar performance figures. Looking back at the Balance Fund, the majority of this performance has come from global equities, but they've also seen a currency effect which has come from a weaker sterling. Allianz are concerned that the US dollar is looking too strong, and they've adjusted their positioning accordingly. They were overweight the dollar, so they had a large position within US dollars, but this has now been adjusted back to an underweight position. Allianz have taken quite a contrarian view compared to other managers, feeling that equity markets are stretched and nervous that the Trump administration won't deliver. Allianz, however, have the ability to react very quickly to how events may change or how markets may change, and they can add or reduce risk depending on levels of volatility within markets. Looking towards 2017, Allianz do feel that they will use a little bit less of their risk budget compared to 2016. Okay, so let's move on to Threadneedle. And Threadneedle has posted some excellent returns for December. Particularly good though, as actually they've had very low or zero weightings in the sectors within the UK that have performed strongly, such as miners and energy. And that just illustrates just how well their bottom-up stock selection process has worked. You may well have seen retailers have been in the news recently with Next really struggling, posting a profit warning. So this is an equity that Threadneedle don't own. However, they do own Marks and Spencers, which is in the same sector, and they feel that with Next suffering from cost pressures, Marks and Spencers could be one of the main beneficiaries. Threadneedle are less positive on fixed interest compared to equities. They've got quite a low duration position, so again, less sensitive to changes within interest rates, and that's of around about 6 years. Threadneedle have also been reducing credit risk within their fixed interest portfolio, reducing exposures to areas such as banks. The fund itself is currently yielding around 4%, and Threadneedle are positive on the sustainability of this level of income. And they feel that currency devaluation from sterling devaluations will carry on through the year, which will help provide and keep those high income levels. Okay, moving on to SEI. Again, looking back over 2016, they posted some excellent returns with their value style bias really working well. There have been no changes to the funds in December, and SEI continue to favour value and momentum as a style. They're potentially looking to add a manager to their global equity building block who'll specialise in emerging markets and frontier markets. They're constructive on developed markets in general, feeling that global markets tend to follow each other, with the US leading the way for others to follow. Contrary to some of our other managers, SEI do not feel that volatility levels will rise under Donald Trump's leadership. And lastly, we have Goldman Sachs. So both the Goldman Sachs Dynamic and their Income Builder Fund posted solid positive returns over December. Income Builder continues to offer an excellent yield of over 4%, and that's paid monthly to your client. The fund has benefited from quality management and good stock selection. The Dynamic Fund offers diversification and exposure to alternative investments, a useful way to potentially diversify away from more fixed interest-based investment. Okay, so that's everything from me today. Thank you very much for listening, and I'll speak to you next time. Thank you.